Disney reported fiscal second quarter results earlier this week, and the market was really disappointed with what they saw. The stock was down about 10% after results were announced. But I think this is one of those cases where investors need to think about the company long term and not just what does the next quarter or two look like. Because I looked at a lot of the reaction, and a lot of it was just uncertainty about what happens next quarter with the streaming business or the quarter after that. Well, what's going to happen with Disney 5 or 10 years down the road? I think that's much more important. And the signs are pointing to this being a very solid business in a number of different ways. One, the parks and entertainment business has just become a cash juggernaut. They're generating nearly $10 billion worth of operating income, growing that at a consistent pace. So that's just like a foundation for them to build the company on top of. The studios are seeming to start to get out of their funk. We'll see what some of the content over the next year or two looks like, but it seems like the pipeline is at least a little better than it was a year or two ago. And then you have a streaming business that's now profitable, barely profitable, but it is profitable. And as the number 2 streaming company behind Netflix, I think that puts Disney in a really strong position that investors aren't really appreciating right now. So I want to dig into the results and show where there were some positive signs and where there was a little bit of disappointment. There is going to be uncertainty over the next few quarters. But I think if we look out long term, Disney has the right strategy. And once you get to fall 2025, when ESPN over the top launches, I think they have a compelling bundle option for consumers as well. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's go straight to the results. I'm going to bounce around here a little bit between the presentation and the press release that has some of the more detailed numbers. But you can see here the revenue was up slightly from a year ago, $22.1 billion. Income before taxes was negative. Diluted earnings per share was negative. But excluding certain items, which is usually what analysts compare their estimates to, you have a pretty big jump in earnings to $1.21 per share. Operating segment income was also up. I'll get to some of those numbers as well. Entertainment results, this is the one that investors are really keeping a close eye on. The linear networks continue to decline. This shouldn't be a big surprise to anyone. The question is going to be, how quick is the decline happening? And it looks like it's taking place at a pretty rapid rate, down about $200 million to $800 million in operating income for the quarter. But look at this, direct to consumer was about flat. So that is improving really rapidly. So you bundle those two things together and you're seeing a pretty significant improvement on the operating income side. This is the direct-to-consumer operating income trends, and you can see that this has rapidly been improving from a $600 million loss a year ago, to a very, very small profit. Now you include ESPN Plus in there, and you go to a small loss, but the trend is moving in the right direction, and that's really what we want to see as investors. These are the subscriber numbers. Big jump in subscribers, and this is just quarter over quarter. This is domestic Disney Plus. This is going to be your highest revenue and really the most important segment for Disney. And a lot of this was driven by what they call charter entitlements. So Charter is now including Disney Plus in their package. They didn't give a lot of detail on whether or not people were actually using that, because this is people signing up for things like broadband cable and also cable TV. So you have subscribers, but are they actually using the platform? Not really clear at this point. But at least we're moving in the right direction from a subscriber number standpoint. International, a little bit weaker. That was down. This is always a little bit convoluted with Disney's results, but because this includes the Indian results where they have very, very low revenue per user, less than $1 per user, and they were losing money there. So they really cut back and said, hey, maybe we don't really want to go after these subscribers that aren't going to financially benefit us. So you're seeing an increase in the revenue per subscriber despite the fact that subscribers are going down. So that's kind of the dynamic there that's going on. This has been going on for a few quarters now. On the Hulu side, you're seeing, again, pretty strong momentum. Video on demand up a little bit from a quarter ago, although prices were down slightly. I think this is probably because of a lot of the bundling that they've been pushing with Disney Plus, but the advantage is the bundle will probably reduce churn for both Disney Plus and Hulu. The other piece that's coming to that bundle is ESPN. That is included in the sports segment. This is really dominated by the ESPN channel, but ESPN Plus is also included in this. We will see an ESPN tile in Disney Plus starting later this year. Probably not going to be a lot of content in that tile, but that's in anticipation of there actually being an ESPN over-the-top service in Disney Plus, in that streaming subscription, in that streaming bundle in 2025. So we don't know exactly what that pricing is going to look like or what the operations are going to look like, what kind of content's going to be there, but look for that. And that's kind of when the vision will be completed, having Disney Plus, Hulu, and then ESPN Plus all on one platform, in one app, one subscription. Ultimately, that's where Disney wants to get to. Experiences, like I said, this is where the money is made. Revenue up from a year ago to $6 billion, and operating income also increasing really across the board. Wouldn't be surprised if some of the growth numbers start to really slow down as people start spending less on things like expensive vacations to Disney World or Disneyland. But this is still going to be the cash flow machine for Disney, and I think that's something that we need to consider as investors. As much as the movies and whether this movie or that movie is a hit really gets a lot of attention in the market, it's really the parks that are going to drive the financial results. I wanted to go over to the press release and some of the detailed results because I think this is really telling about the direction of the business and the scale of the business. One of the things that I think investors often miss in Disney's results is that the direct-to-consumer or the streaming business is much, much bigger on a revenue perspective than linear TV networks. Not as profitable, but much bigger from a revenue perspective. So yes, it's going to be lower margin, but in time, it may actually be more profitable. So we saw an 8% decline in revenue for linear networks, a 13% increase in direct-to-consumer. So that is moving in the right direction. Obviously, we have the sharp increase in operating income, now $47 million for direct-to-consumer, and linear networks declining 22%. So this is obviously not being replaced by direct-to-consumer yet, but again, think about what this product looks like, this direct-to-consumer product looks like 5 to 10 years from now when you have Disney Plus with your proprietary content, all the Pixar movies, kids content, Marvel movies, all of the Disney properties. You add in Hulu with general entertainment, and then sports with ESPN. We now know that ESPN is probably going to have NBA content. They're going to have college football content, NCAA basketball, Monday Night Football. There's a ton of content that's still going to be on ESPN, and if that's going over the top, that's going to be probably a attractive piece of the bundle, driving these streaming numbers even higher. So that's something I think that we need to keep an eye on. Do we know exactly what next quarter is going to look like? Probably not. But do we know that in the future, we're going to have more subscribers as part of that Disney bundle, paying overall more money and churning less? I think that probably is the case given the way that things are going. This is just a look at the subscriber numbers, and you can see here the domestic numbers up 17%. Like I said, that was a big part of that charter deal. So we'll see if there could potentially be more deals like that in the works. Hotstar was down 6%, and overall the core business was up 6% for the quarter. Revenue, this is also the thing you want to see moving at least a little bit higher. Domestic, this is probably part of the bundling, and then also the impact of the charter deal. A 2% decline in revenue per user, but you did have a nice increase internationally. So that's generally, I think, the trend that we're going to look for with Disney from streaming. Although on a quarter-to-quarter basis, you may see a little bit of lumpiness depending on advertising revenue, depending on what sort of deals are struck to reach a wider audience. But I would much rather trade an additional 6 million subscribers for a 2% loss in revenue per subscriber. I think that's a good move for Disney as you're trying to scale this business. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So I think a huge part of the market's reaction was just uncertainty about what streaming looks like over the next few quarters. And that's really, I think, something that's not all that concerning. What we should be more concerned about is, are they cutting costs to a point where they can actually make profit on streaming? And the answer to that is yes, or it was yes in this most recent quarter. So I think that's definitely moving in the right direction, but we're not going to really fully know what this streaming bundle and this streaming service looks like until you get ESPN adding to that bundle. I think that's going to be a center of gravity for a lot of different consumers, and given the way that they price this product in the past, at least from a bundling Disney Plus and Hulu perspective, it's probably going to be pretty compelling to have all three of those bundled together, have kind of like your mini cable bundle under that Disney app. And if once they do that, once you have 100 million plus subscribers, maybe even 150 million plus subscribers by the time ESPN launches, now you start to have more power in the market. Now you're starting to get to the point where you can dictate terms to not only other content studios that you may be buying content from, but also distribution partners. And that's where Netflix is today. It's not quite where Disney is right now in their streaming journey, but I think we're seeing this definitely be the number 2 player in streaming. And I like the vision that they have, but it's going to be pretty lumpy in the process. The good news is you have that Experiences core to fall back on and about $10 billion in operating income there. So don't forget about that when you're looking at Disney stock. Yes, the movie studios get a lot of attention. Yes, the streaming business gets a lot of attention, but the cash flow business is that entertainment business. And that's something that Netflix can't compare to, Apple can't compete with, Amazon can't compete with. That is a Disney specific business and part of their business model. So that's why I'm still bullish on Disney long term, but it's going to be a long time to see this play out. So we'll see where the stock goes over the next few quarters. I will be back with more Disney coverage here. So don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.